Hello guys, can you guys hear me now? Okay, sorry about that guys. Sorry, we're having technical difficulties here on this side. Again, my name is Dustin Trandai. I'm one of the illustration specialists on the sales desk here in Texas in the Dallas office. I want to say thank you for taking the time out to attend this WebEx. I hope at the end of this presentation you'll be more confident and more knowledgeable on presenting the reports to your clients when you're trying to make a sale. We will be getting started. Again, my name is Dustin, and we're going to be going over the illustration PDF walkthrough today, okay, guys? So if you guys have any questions, we're going to have this chat box opened up. If I don't get to it right away, I will get to it by the end of the illustration or the webinar. Don't feel like I'm just ignoring you guys, okay? Okay, so right here you guys can see my Skype, correct? All right, so this is what it's going to look like when you guys are trying to run an illustration. You're going to log into your agent portal. This is going to be your agent portal right here. If you guys want to run an illustration for your clients, you're going to go here and then click on this illustrations here on the left-hand side under Business Tools. Just click on that, and then we're going to get into the illustration software. All right, so first we're going to go through our term illustration PDF because we have a new term rollout that just rolled out this not too long ago. We're going to go over it. The reports do look a little different for the new term. So here, let's say we want a term. Let's say it's in Texas, and we're going to do LSW term. All right, so we put the client's information. Let's just put mine in. We can just leave that. I'm standard non-tobacco. And let's say I wanted $300,000 in coverage for my family if something were to happen. Okay, so before you guys run the reports, depending on what type of term that your client wants, whether it be 10, 15, 20, or 30, we can choose it right here. Go to reports, and then whichever one they want, you can choose. This is going to be the one that's illustrating right here. So right now we're illustrating 20-year term. And then on the illustration, we're going to show actually the comparison to a 10-year term, 15-year term, 20, and 30. Now, if you guys don't want that to show on the report, you don't need to have it, but you will have to uncheck these boxes. These are going to be automatically checked, okay? So we have the 20-year term. Let's just run the report. Okay, for some reason it's saying blocking it. All right, so run the report. There you go. So here's the cover page. You see the puzzle piece that we stand by. It's a very good selling point if you're talking to your clients. If you die too soon, we'll take care of that in the life insurance portion. If you become ill, we'll take care of that as well. We have accelerated living benefits. And if you live too long, we have our policies actually have a lifetime income benefit rider that will come with it. On the term, it does not, but with our other products like the IULs or ULs or whole life, there will be a lifetime income benefit rider that you can activate. Okay, so we'll scroll down. That's the cover page. Scroll down. This is going to be why you want life insurance, right? Going through this, our term life, it's very affordable. Actually, with our new rollout, we are very competitive. The cost has gone down a little bit, and our ABRs are still as good as they are. I'm sorry, guys. A few people are saying they cannot hear me. Are you guys able to hear me? Okay, so some people can hear me, some people can't. You guys might want to try unmuting. Maybe you guys got me on mute if you guys can't hear me. Okay, thank you guys for everyone that's saying yes, they can hear me. So again, this is just a page that explains why cover or life insurance is necessary. Death benefit can be used to protect your home, to protect your children when they grow up, to protect your business, protect your family, help college fund tuition, and help supplement a spouse's income. Now, you can't really fund a college tuition on a term product like you would on the IUL unless something were to happen to you. Then your beneficiaries can use it for their college funding. All right, so we scroll down. This is going to be the summary of coverages page. So because it's term, it's pretty straightforward. If you die too soon, if you were to pay all your premiums, your death protection would be $300,000 for Dustin Trandai, which is me. It comes with accelerated living benefits. So it will come with terminal illness, chronic illness, critical illness, and critical injury. That's what this is saying right here. Now, if it does not come with it, let's say your client was sick or had some kind of heart problem that our underwriting says you don't qualify for critical illness or critical injury, then we'll take that off, and you won't see it here. But if you see it here, that means you do have it on your policy. All right, so living too long, these are conversion periods, and with a term, you can convert over to a permanent. There's no cost for conversion fee, which allows you to convert your term policy to a life insurance of the Southwest permanent policy. And it really depends. The conversion periods really just depends on the term that the client gets. If it's a 20-year term, you got 15 years to convert. That's why it's saying you got 15 years right here. It's because we're illustrating a 20-year term. If it's a 10-year term, you have a full 10 years to convert. If it's the 15-year term, you have 12 years to convert. And again, if it's 20, you have 15 years like we show here. And if it's a 30-year term, you have 20 years to convert. Or to the age of 70, whichever one comes first. All right. Again, down here is the summary of coverage page, but in numbers. So terminal illness. Let's say you were to start. This is a summary page at age 50. So at age 50, if you were to have some kind of terminal illness, this would be the expected discounted rate that we'd offer. And terminal illness is a lump sum. So just know that terminal illness, whatever we offer you, is always going to be a lump sum. And ABRs are always calculated off of the death benefit. Okay, guys? Chronic illness, if you go down here, these are different ages that if you were to accelerate. So if you started to accelerate a chronic illness rider at 47, this would be what you could possibly get monthly. Okay, chronic illness is paid monthly, and there is a 90-day waiting period for this rider. Okay, so your client must have had 90 days worth of the chronic illness to activate it. At age 49, this is what we would offer. At age 51, this is what we would offer monthly, and at age 55, this is what we would offer monthly. Again, you can accelerate up to 24% of the death benefit every year if you did chronic illness. So after 4 to 5 years, you will no longer be able to accelerate chronic because your policy would have had lapsed. Okay, so that's with chronic illness. If we go down, again, we see different ages, 47, 49, and 51, and 55. Okay, critical illness and critical injury are paid differently than chronic and terminal. It really depends on how severe the illness or injury is. So if it was just a minor injury at age 47, this would be the lump sum payout that you'd be getting. Okay, this is what we offer, $16,000. Now your death benefit was $300,000. You're already 45, so if you were to accelerate at 47, you've only had the policy for 2 years. And if it's a minor, the acceleration is not, or the amount that we accelerate is not going to be that high. Okay, and this is going to be lump sum, just like the terminal illness. All these numbers here are lump sum. So minor, it's always the least amount of payout. Moderate, and it goes up and up. So life-threatening, you always get the highest amount. If you take out that full amount that we offer you, that full discounted rate of the $242,952, if you accelerate the full amount, then that'll lapse your policy. You fully accelerated your benefits. You no longer have a policy if you take that full amount. Now, let's say you don't want to take the full amount. You're it's life-threatening, but you still want to leave your beneficiary with some of your death benefit later on. Let's say we offer you the $242,952 at age 47. Let's say you were to have cancer, it's life-threatening, so we would offer that amount, but you don't want to take that full amount, you take 50% of that. So if you take 50% of what we offer you, which would be about $121,000, then we'll take that ratio of 50% and deduct your initial face amount by 50%. So you take out 121 for yourself, and then we leave the policy with $150,000 in coverage. So then if you were to pass away, your beneficiary would get $150,000. There was a question if ABRs is tax-free money. It is. Because it's coming off the death benefit, it's calculated off the death benefit, it will be tax-free unless you have MEC'd your policy, which you can't do really on a term policy anyways. We'll get more into MECing in the Flex Life 2. Okay, so we scroll down. Here are the options to pay your premiums. If you wanted to do annual, we'll show what the annual amount would be, $738 for annually. Okay, and then if we go down semi-annually, it'll be $376. So you'll be making 2 payments of $376. You see that the total yearly premium is $752. So if you were to pay semi-annually instead of annual, the client would have paid an extra $14 if they had just paid annual, and so on. If you were paying monthly, it's 12 payments of $64.94. The total payment for that year would be $779, and you would have paid $41.28 extra compared to the annual cost. So here, the client can see how beneficial it is to pay annually compared to monthly, quarterly, or semi-annual. Okay, with term, monthly is always going to be more expensive. All right, we'll go scroll down. This page is just rider description. It'll go over the ABRs and what the ABRs are. It'll tell you exactly the client what classifies as terminal illness and what classifies as chronic illness, and so on, critical illness and critical injury. Okay, so this is just going over all the riders that's included on here. And we can go down, just continuation of the rider descriptions for the ABRs. All right, so here on this page, the definition of key terms. There's some stuff that the clients need to know while looking at this report, where to find what age is, face amount. I know it's a little straightforward, but some clients really don't know. So age, face amount, guaranteed contract premium, the annualized guaranteed maximum premium for the term policy based on the premium mode selected. Right now, we have selected monthly, so we're paying $64.94. Guaranteed death benefit, what we are insuring. Policy years, rate class. Rate class is what they're going to be rated. Right now, I'm rated standard non-tobacco. That's going to be my rate class. Cost index statement. This really does not really affect anything because we're not really invested in the index. Okay, so this is just, we're doing term right now, so it's not really necessary for this. There was a question, does nearest age mean within 6 months of the birthday? Yeah, so if you're 6 months closer to your next birthday, let's say I'm 45 right now, 6 months from now I'll be, let's say 5 months from now I'll be 46, so my actual insurance age would be 46 because I'm closer to 46 than 45. It's whatever age you're closest to. Okay, so we go down to the ledger. Policy year, first year, I'll be 45 years old. I'm paying $779 total in that year. Even though I'm paying monthly, that's what it adds up to. And I'll be getting a guaranteed death benefit of $300,000. As long as I continuously pay the premiums for 20 years, I will be guaranteed that death benefit. Okay, guys? So we see after the 28th year, we see that it jumps up significantly. We're seeing $5,626 for the term, which is not really true. If I wanted to continue my policy, all I would have to do is apply for another term. This is saying if I don't want to apply for another term and I just stake on this term, because I only applied for a 20-year term before, the prices will jump. But most of the clients, if they have a 20-year term and after the 20th year they haven't converted yet, they would just apply for a new term and those rates would be changed. Okay, guys? So it keeps scrolling down. It just keeps going up and up. Obviously, no one wants to pay that much. Okay, this is the page that I was talking about, guys. This is really cool. This is going to be our comparison now. We can compare to what the cost would be if I were to have a different term. Let's say the client was like, I don't know if I want to be insured for 20 years and said, I want to be insured for 15. What's going to be the cost to do a 15-year term for the same amount? Beforehand, we would have to run a whole new illustration, show it in a whole new illustration. However, now we have it compared side to side. So if we take a look at this, for a 10-year term, if I were doing annual, the total amount would be $507. Compared to a 20-year term, if I were to do an annual amount, I would have paid $738. Okay, so the client can see here, it's cheaper to do a 10-year term. It's because we're not insuring them as long. So if we want to go down here, let's say year 6, instead of doing a 10-year term, let's say 15-year term. $639 is going to be what it costs for the client for a 6-year or a 15-year term for $300,000. If they wanted a 20-year term, it would cost $779 a year. If they wanted a 30-year term, it would cost $1,302 a year for the same amount of coverage. Okay, so it's really cool on term illustration that we got here. The client can see exactly how long each term is and how much the cost varies, okay? So we had a question about ART. ART is simply just annual renewable term. That means they have to reapply for it every single year. All right, and we just keep going down. It's just more of the ledger. All right, so this is the term. It's a little more straightforward. Let's get into the Flex Life 2 illustration. It's gonna be it's a little more difficult to explain to your client. So let's get over there. There was a question, what happens to the extra money that you put in if you pay monthly? Nothing. Simply, it's a term illustration. So if you're paying monthly, it just costs more to pay monthly. Because you're breaking up the payments, the cost is a little more than if you were just to do a one-time payment annual. Kind of like a gym membership. If you were to pay monthly, it's always more expensive. But if you were to go to Costco, buy the 2-year membership, you pay it all up front, it's a little less expensive. Okay, so that was term. Let's go over to Flex Life 2. So we're going to close out of this illustration and go to Flex Life 2. So we're going to Texas and Flex Life 2. So there's a question, after year 21, can a client reduce the base amount and pay the same amount of premium? After 20 years, your policy is pretty much over. And if you want to stick to on the same contract, then the premiums would have costed what we showed there. If you want to reduce the base amount, you would have to reapply for a whole nother term. Okay? So this is Flex Life 2. So we're going to put in our information again. Again, guys, this is just the PDF walkthrough, so we're not going to spend too much time on the illustration portion. Let's say I'm 34. Okay, so for here, let's do minimum death benefit max cash value. I want to maximize my cash. We're going to do increasing because I'm a little younger. And let's level it off at age 66 when I want to start retiring. Okay, so annual, let's say I can put $500 in. Thank you. Okay, so putting $500 in, paying to age 65. Again, we have to put the A65. And then we want to show income, okay? All right, so we're showing income at age 66. Okay, there you go. Everything's working now. All right, so let's go to quick view. Thank you guys. I have fixed the age. I didn't realize I put 334. That'd be pretty ridiculous if someone was 334 years old and getting insurance. All right, so here we're showing income. We see that on the illustration software, we don't see a lapse. We don't see a MEC. That's good. That's what we want to see when we're illustrating. And we're showing the initial face amount of $210,000, paying $500 a month. We're max funding it, so we're paying guideline level. And we see income coming out at age 66 of $53,000, okay? So let's go to the report and see what that looks like. Okay, guys, so again, this is the cover page. The cover pages for our products are most likely going to look the same. Die too soon, again, you got the coverage. Become ill, you got the ABRs, which is the Accelerated Living Benefit riders. And if you live too long, we got the Lifetime Income Benefit rider, okay? So go down. This just tells you about what Flex Life 2 is and what life insurance is with us. It's really just going over what Flex Life 2 is, what products you're buying, what's included in the Flex Life 2, and what Flex Life 2 is really used for. Flex Life 2 provides a tax-deferred buildup on a policy cash value, values that can borrow or withdraw income tax-free as long as you don't MEC the policy to achieve your unique and personal objectives, okay? So sometimes people could use this for college funding. Sometimes people can take out loans for a house, on a mortgage. It really just depends on what your client wants to use it for, but it has multiple purposes, which is really cool. Flex Life 2 is our flagship product. I really love it. I even have it on myself. It's a great product to have. All right, so we scroll down. Here is just a summary page. If I was at age 66, what my payouts would be or what my policy would look like. So at age 66, I have been paying annual premiums of $6,000. By age 66, my death benefit, my face amount death benefit has grown to be $722,000. I initially started with a face amount of $210,000. At age 66, it has grown to $722,000. Or initial income at age 66 of $53,000, almost $54,000. There was a question, what does a MEC mean? When I say MEC, it means Modified Endowment Contract. That's when the government is looking at this policy, your client's policy, and seeing that it's not used for just strictly life insurance anymore. The client has paid so much into it that they're using it more for an investment vehicle. So then the government's going to want to get their money from it as well, and they're going to charge you taxes on it. So you never want to MEC a policy for your client. The client never wants to MEC it. Anytime you start pulling out loans, and your policy is a MEC, then you will have to pay taxes on it. On the interest gain, not on the money that you put in, but on the money that you've gained. And again, it's going to be on a first in, last out basis. The monies are on a first in, last out basis. Total income benefit received. So this is what you'd be getting at age 66, which is the $53,000. If you were to completely take out $53,000 every year till age 120, which is maturity of this policy, you would have pulled out a total of $2,965,000 and $435. Okay. Your living benefits at age 66. If we scroll down, this is what it looks like for living benefits. Your terminal illness, your payout would be a $631,000 lump sum if you had terminal illness. Critical illness at age 66 would be $11,000, almost $12,000 a month. And then so on. Critical illness is $616. critical injury 616, and that's going to be based, right? The 616 is going to be based off of the life threatening, okay? And critical illness and critical injury is paid on a lump sum, just like terminal illness. So if we scroll down, this page right here, strategy that provides multiple options, it's simply a graphical terms of what we just talked about. Total premiums at age 66, you would have paid almost $200,000. That looks like $180,000, $190,000. Your guaranteed death benefit would be about $300 and maybe $25,000. But your actual net death benefit on what we actually think the market's going to perform like and what we think it's going to look like, you're going to be getting a death benefit of 700 and I believe it was like 19,000 that we talked about earlier. The terminal illness at age 66 would be a 690 or 620,000. Chronic illness, it was 11,000 each month. So over 4 or 5 years, you would get about almost 600,000. Critical illness, critical injury, it was 616,000 at age 66 if it was life threat. Okay, so this is just a graphic graph of what we talked about before. Some people like to look at graphs. They like the picture better than the numbers. Some people like the numbers better than the picture. So whatever your client likes, they can take a look at this and see what they're actually buying and what their money's actually getting. Okay. Again, it's on a discounted rate. This is not including any loans that you could have possibly taken out or anything beforehand. All right. So we scroll down, summary of coverages. Again, it's just going over what you have with the policy. The initial death benefit that you're going to be protected when you start the policy is going to be $210,000. And then right below that it's going to be telling you the accelerated living benefits that come on it. Again, if the underwriters tell you that it's not on the policy, then we won't allow it. We would have to take it off. Sometimes they'll say no critical illness, no critical injury. If they say that and it's still popping up here, just go back to the illustration software and just take it off. You can do that by, I'll actually show you right now. So I'm just going to minimize this. So if the agents want to, or if the underwriters tell you can't have it, just go to your rider section and you can take it on and off here, okay? If the client can't have it, if they don't qualify for it, you can take it on and off. Okay, but we're going to leave it on and go back to the report. Additional benefits, these are other riders that automatically are on your policy, on any policy, but it comes with no cost. So this is the CMG, Charitable Matching Gift Death Benefit Rider. We do a charitable gift benefit. So if your client wanted to give some of it to charity, it comes with a rider. Interest crediting strategy rider, that just tells you that there's different interest crediting strategies and you can exchange them whenever you want. Lifetime income benefit rider, that's going to be when it's automatically on the policy, but you just got to activate it. Lifetime income benefit rider, that means when you turn it on at age 60 or 65, whenever you want to start retiring, we'll make an offer of an amount and we'll stick by that for the rest of the policy. So right now we were illustrating, I believe it was a $53,000 income. If we did LIBOR, it would be less than $53,000. It might be like $50,000. We do that, it's less because we guarantee that the policy will never lapse and we guarantee that you can have that amount for the rest of your life. So if we guarantee it, we got to give you a little less than if we just did a solve for income. Solve for income is not guaranteed, but it does come out with a higher payout. Over loan protection rider, this rider just simply means that before you can over loan your policy where it doesn't lapse, we'll let you know. We'll let the client know, hey, you're about to lapse the policy if you take out that much. So we won't let them do it we won't let them lapse their policy on accident. We'll let them, our enforce team will let you guys know how much you guys can pull out. And if you guys want to pull out more and lapse the policy, that is up to the client. But we will have that rider on there just to make sure that it does not get over loaned and lapse. Okay, and the systematic allocation rider, just how you want to allocate your money. If we scroll down, it looks exactly like the term illustration of your ABR page. Terminal illness at age 65, this would be the payout. Chronic illness at age 50, that's monthly, what you'd be getting. At age 60, that's what you'd be getting monthly, and so on, 65 monthly and monthly. Again, guys, chronic illness, make sure your clients know that chronic illness is monthly. It's the only ABR that's going to be paid out monthly. Everything else is lump sum. And they can accelerate the chronic illness rider for 4 years. That's if they maximize their payouts. All right, critical illness, critical injury. Again, it really depends on how severe it is. If it's minor, moderate, severe, or life-threatening, the payouts will be different. And it also depends on the age. Okay. Great question. Someone asked, why did I choose B? So if you could look up here what your policy has. So my name is Dustin Trandai, face amount here. Death benefit option is B. The reason why I did B was strictly because I did a minimum death benefit max cash value. So I didn't really care too much about having a high death benefit. By doing B, it allows us to solve for a smaller initial death benefit because we know it's going to be growing later on. It's going to eventually hit the high numbers where our actuaries have taken a crack at the numbers and figure it out to where we can get that number lower. So the cost of insurance is a lot less. If we did level, the initial face amount would be higher, so the cost of insurance is higher. So then the rest of that cash will not be going towards your investment towards the index to grow. Okay, so because I'm still young, I'm 34 years old, I don't really care too much about the face amount. I do increasing B. That's to maximize your retirement. That's to maximize cash accumulation for someone that's younger. Chronic illness pays out a max of 4 years. You can maximum offer is 24% of your policy discounted rate. So 24% each year. So after 4 years, you'll be at 100%. Okay. All right. So again, minor, moderate, severe, life-threatening. It really depends on how severe it is. We'll get the severity from the doctor, and they'll let us know what they think it is, and from there, our underwriters will take a look at it, and then our claims department will offer the claim. Okay. And if you take out only 50% of what we offer you, then we will take 50% of your death benefit. If you take 75% of what we offer you for the critical illness or critical injury or terminal illness, if you take only 50% or 75%, then we'll leave 25% of your death benefit. Okay, so it's always a ratio, so it's 1-to-1. So let's scroll down. This is just a plan description. This is telling you what Flex Life 2 is. It's telling you how you can fund your Flex Life 2, what the surrender charge is on the Flex Life 2. This really goes over what is included in this policy, okay? So you have current illustrated rate. It shows you what's in the report. It will tell you what each illustration looks like. So we're going to have 3 different illustrated rates. There's a current illustrated rate, alternative current illustrated rate, and guaranteed illustrated rate. We'll get to that as we scroll down, but this page is simply telling you what you're about to see in this policy. If we scroll down here, this is a very important one. It will tell you if you want to take out loans, there's different types of loans that your client can take out. If your client doesn't know what each loan is, or if you don't know what each loan is, I highly suggest reading this right here. Participating variable loan, that is probably the most common loan. The standard loans is here, and participating fixed loans. Just go through it. You'll be able to understand the participating variable, standard loans, and participating fixed loans if you read through it. This is really just telling you what type of loan options you can choose when you want to pull out. Let's say if you had you want to pull out some loans for a mortgage, you can choose what type of loan you want. You don't have to choose it right now. The client doesn't have to choose it when they're starting the policy. They'll choose this when they want to take out the loan. Okay, guys? And whenever you guys take out that loan, there's going to be a loan rate, and we'll let you know what that loan rate is, okay? Right now in this illustration software, it's saying that we're showing a 5.88% loan rate. Now that can change when you choose to take out a loan, but this is just what we're illustrating. All right, if we scroll down, this is a rider's description page. Again, this is just going through what riders are on your policy and what each ABR means. I did not say don't choose participating fix. It's really up to the client on what loan they want to choose. Okay, so each loan has their own quirks and nits. All right, so this is the ABR page. It tells you what each ABR is and what qualifies as a critical illness, critical injury, chronic illness. Again, scroll down. Here's more definitions about each of the other riders that we included on there. I already went over some of them, but here it just has it in writing for your client if they want to read through it and what loans or what riders that they have available to them. This gives them a description of each rider. Okay. Scroll down more. It's just key terms. What the client really should know about this policy while reading through it. They should know all these key terms so they can get a good understanding of what they're getting. While there's a question, are you allowed to write on the illustration? You can. It's not going to affect anything it's not going to have a huge effect. When you're applying, there's going to be an illustration ID number at the bottom. We didn't save this illustration, so we don't have that ID number. But typically, there's going to be an illustration ID number that you'll attach to the application. So even if you wrote on these illustrations, we will have that ID number to go back and see what you actually want. And in the application, you're telling us exactly how you want to design the policy anyways. The illustration is typically, we want the illustration to be signed by the client. That way we know that the client has looked through the illustration and had got a full understanding of what they're buying. That's the whole point of having the illustration. So if you're going through the illustration and you're highlighting things to get the client to understand it a lot better, that's even better for us. That makes us feel more comfortable that the client knows what they're buying. Okay. And there was a question about what the MEC premium is. This is another description right here. If the client doesn't know what MEC is, they can read this and it'll tell them exactly what the MEC premium is. Okay. Scroll down, just more key terms that the client would, I recommend the client know, because if they don't know these key terms and then going through the illustration, they might be missing some key information. Scroll down, this is just more key terms. Continued, index strategy disclosure. This really goes through our index strategies and how indexing works. This is a really, really important page for your client because that's why they're buying an IUL, right? If they just wanted specifically just coverage, they would have gotten term. So this page is very important. It's the index strategy disclosure. It tells them exactly how index strategy works, what each strategy is, and which one, if they wanted to put their monies into one strategy, what strategy does what, okay? So I would highly recommend, if you guys don't know what each strategy is or how indexing works, please go through this page because that's the whole point in IUL. It's called Index Universal Life for a reason. So we are invested in the S&P 500. So if you guys don't know what each strategy is, go through this page. It'll tell you exactly what each strategy is. And this just continues on about index strategies, okay? Here on this page, this is showing you what each index strategy has looked like over the past few years. It'll tell you exactly what the S&P 500 did, and then it'll show you what we have credited on the index strategy, depending on what strategy. Strategy 1, Strategy 2, point-to-point cap focus, point-to-point participation focus. there's different strategies, and it'll show you what the strategies are. So let's say in 2008, the market did negative 38%. We obviously credit 0%. You're always protected by that 0% floor. Okay. And then we have a 11%, let's say 2014, S&P 500 did 11.39%. On strategy 1, we have credited 11.39, strategy 2, 9.25, so on, so on. This is a really good page too for your clients. If they're questioning, oh, I don't know about the indexing strategies, you can show them this page and you show them, okay, this is what the market did and this is what we've actually credited your policy. It's a really cool page. I really love it. You can see the down years that the client is protected, and through the up years they get the gains as well. Okay. There's a question, can you go through an actual sales presentation to show what you actually do with clients? So unfortunately, we don't have time to go through a whole sales presentation. There are other webinars. This presentation is strictly just to go through the illustration PDF, okay? Great question. There was a question on this illustration, what strategy did you choose? So we're about to get to that right now. Actually, I'm about to scroll down, and this is what this page right here is showing you what page the client is actually putting their money towards. So right now, we see that 100% of their monies are going into the strategy 1. Okay, so on the illustration software, you can allocate that money elsewhere. So you can do 50% strategy 1, 50% or 25% strategy 3, 25% strategy 4. As long as the percentages add up to 100%, that's all that we care about. If it doesn't, we won't even allow you to run the illustration. It'll just have a red X. But on this page right here is going to tell you exactly where your money is going. Okay, so we have 100% going into strategy 1, which is the default. Strategy 1 over time has just performed better historically, so that's always the default for us. Unless your client says elsewhere, then we'll put the money elsewhere. But if not, then we just leave it at strategy 1. Scrolling back up, this just tells you what each strategy is, and it'll tell you the caps right now. You can see strategy 1, the cap is at 11.75. Strategy 2, there's a 9.25% cap, and so on and so on. Okay. All right. So let's scroll down. Oh, it tells you cap and participation rate. And we just went over that page. Here is the guaranteed illustrated rate. So this page, guys, I don't like to focus on it too much. Some clients would like to see what's guaranteed. If they want to see what is guaranteed, that our company will stand by, that no matter what, this is what we guarantee. No matter if the market's too horrible, this is what we guarantee. If we go out of business, this is what we guarantee. So guaranteed rate, I don't like to focus on it too much. It's not very accurate. It's really, if the market does horrible and we go out of business, this is what we will give you. However, we've been around for 180-something years, 170 years, through all the world wars, and we still have been around. So it's not very likely, but if your clients really are a stickler about guarantees, then you can show them this page, okay? Our guaranteed rate is showing a 2.5% growth over the whole policy. Not every year, but over the whole policy, the monies that you put in, it would have only grown 2.5% over time, okay? So that's guaranteed on the guaranteed side. So we show that we actually show that the policy will continue as long as you're paying your premium. We guarantee that your policy will make it all the way out to age 69. At age 69, you would have had started pulling out income at age 66, $53,000 in annual income right here. But it would have lapsed on the guaranteed side. So if we went out of business, we would have guaranteed that you gotten at least $53,000 for 3 years, as long as you were making your payments every single year, and it will lapse at age 69. Now, it's not very likely that this will happen, but it's a possibility. We have to show it on the illustration just because for compliance purposes, we need to have something guaranteed on there. All right, so that was on the guaranteed side. We scroll down. Now, this is the ledger I like to focus on. Sometimes your client will be a little more of a stickler. They want to see the alternative current rate. It's a little less we see that the interest rate is growing at 3% here. Whereas the current illustrated rate, this is what the actuaries actually think the policy and what the market is going to look like, and what your policy will actually look like is the current illustrated rate. And we show that growing at 6.88% over time. Yes, so on the guaranteed side, at age 69, the policy lapses, which means the client would no longer have a policy and no longer being covered. All right, so on the alternative current illustrated rate, let's take a look at it. We're growing at 3%. Again, guys, this column right, this page right here, this column right here, it's going to go across the board. Okay, so it's for both alternative and current illustrated rate. So you're paying $6,000, growing at 3% on the alternative current side and growing at 6.88% on the current illustrated rate. All right, so if we scroll down on the alternative current rate, if it grows at 3%, it's only half a percentage more than the guaranteed side, and we show that it lapses year 70. So it doesn't make it that much further than the guaranteed side. On the alternative current side, if it's only doing 3% over the life of the policy, it'll lapse in year 70, okay? If we take a look at the current illustrated rate, well, this is what I like to focus on. This is what the actuaries actually think the market's going to be doing. We see that the policy does not lapse and it's going to continue going forward, and you're still getting that income over here on the $53,000. Again, guys, it's going across the board. So you get $53,000 at year 72 on the current illustrated side, and it goes all the way to 120. So we still see it going. So on the current illustrated side, it still has not lapsed yet. Now, everything's changing. Your death benefit is going down because you're pulling out income as a loan. At age 120, you're still going. At age 113, the policy is still going, and it makes it all the way out to age 120. If the market does what we think the market's going to be doing, it'll go all the way to 120. All right, we go scroll down. Here is just a bigger version of the current illustrated rate. It's exactly the same thing that we just looked at. It's just a little bigger. I like to show this page as well, but sometimes your clients like to look at two different scenarios of what ifs. You know, so some clients don't feel like the market will do what the actuaries think, even though our actuary team is very good. All right, so we scroll down, the current continuation of the current illustrated ledger. Keep scrolling down. And this page right here is a statutory premium. This is a really good page. This is for you agents. This is what you want to know. Guideline single. This is the max you can pay, and I believe it's 10 in the first 10 years, or no, first 7 years. Sorry, first 7 years. That's the max you can pay. This guideline level, $6,000, what you can pay continuously every year. If you pay more than that later on during the years, it's going to have to be reduced, or you're going to mech the policy. The mech premium, this is what you can pay the maximum in the first 7 years without meching the policy. If you pay more than $6,683 in 1 year, you will mech the policy. If you mech it, again, guys, that means Uncle Sam's going to want some of that cut, and they're going to be taxing you on all the interest gain. All right, minimum premium. To your client, this is the minimum it would cost to start your policy. Just because they pay the minimum every single year does not mean the policy will stay in force. Later on, it will lapse eventually. Okay. Target premium, it's like the middle between minimum and guideline level. Now, target premium, it doesn't mean anything to the client at all. They can pay anywhere from minimum to guideline level. Target premium is simply for you agents. That's what commissions are based off of. Now, the split between the commission and the agency and everything, that's going to be up to the agency and the contract that you guys are with, okay? And we scroll down, summary of values, what they'll be getting, and then they'll sign right here. This is where you want to have the agent and the client sign. We did not include the expenses page, but let me add it to it. So let me show you how to add it. Let's say your client wants to know what the expenses are for the policy. We can add it. Go to reports here on the illustration software. And if they want to add anything, let's say they want to know the policy expenses and charges, you can add it. Just click check, and we can run that report. Let's see what it looks like, guys. So we scroll down. So the policy and expense pages, since we added to it, it's going to be after the signatures. But this will show them exactly what the cost of insurance is at each age. If they had any other riders on there, the cost of those riders, which we did not add any additional riders to. Other deductions, that's really just like what it costs to keep the lights on here. So the premium charge expense, the cost of insurance, and the other deductions adds up to the total expenses and deductions, okay? And then we get the cash surrender value. And this is how, let's say your client wants to know how much the cost of insurance is at age 56. Oh, and this is going to be yearly, so $792 is yearly the cost of insurance. It continuously goes up because your death benefit will go up and you're getting older. So it does continuously change. All right, guys, so that's the end of this webinar. If you guys have any other questions, I'm going to be staying on a few more minutes, and we can go over those questions that you guys have. And again, if you guys have any other further questions, you guys are always more than welcome to call back into the sales desk at 1-800-906-3310, option 1, and someone on the sales desk will be more than happy to help you guys out, okay? Okay, so there's a question. How do you explain to the client if this is a permanent insurance? Why is there a lapse on the years? So it is a permanent insurance, as in it does grow. You do get to keep your money with the policy. So you're not just getting the death benefit like you were with term, whereas term, if you, after you stop paying, after those 20 years, you no longer have the policy. With our policy, if you continuously pay the premiums and the market does well, we'll guarantee that you have coverage. If the policy lapses, you do not get any money back. Whatever the policy does, let's see, let's scroll up. On the alternative side, we do show a lapse. Let me show you. So we see it lapsing, so your cash surrender value will no longer be in effect. There was a question, is Living Life and Flex Life 2 are two different products? They are both IULs and they both perform similarly. Only difference is Living Life is used for a specific agency, okay? Okay, guys, so we're getting more off track here. Let's keep the questions to any of the illustration PDF, all right? So if there's questions on that, I'll be more than happy to answer those questions. But if it's not, then you guys are more than welcome to call 1-800-906-3310, option 1. There was a question, if you have a 34-year-old and they're more concerned with cash accumulation, is option B the best case? Yes. Option B will be if you're doing minimum death benefit max cash value. That just it allows you to get that death benefit lower at first. So the cost of insurance is less. There was a question, MEC 7 is the max you can put in the first 7 years. Yes, so that's going to be the max you can put in every year for the next 7 years. After those 7 years, we will probably not allow you to put in as much. We'll probably tell you that, hey, your policy is about to MEC. You can't put in this much. You'll probably be only put in, let's say, 1/3 of that now. If you continuously put in more than that, your policy will become a MEC. Okay, so there was a question. It doesn't really gear towards the illustration PDF, but if someone does get sick abroad while traveling and they were to pass away, we would still cover that. It still would be covered. So there was a question about competitive CC that the client chose AIG over NLGs. I don't know why the cost of AIG or anything, but I do know that our ABRs are really good. We have one of the best ABRs out there for life insurance, which is why our prices are a little more expensive every now and then. But if with our ABRs, it does play a part into it. We also offer lifetime income benefit. Can you change the policy after it's already been enforced? So with our Flex Life 2, it's very flexible. You can always call in, the client can always call in to decrease the face amount or increase the face amount. They can always call in. Now, if they want to increase it, there will be underwriting that will need to be taking place. If it's an older client that wants to cash accumulation, will you still use min-max? That really just depends on a case-by-case scenario. Let's say that they already had a term policy for their death benefit. They don't really care too much about that, so they already have a high term policy. Then we can do min-max. If they simply just only have a Flex Life 2 policy and they still do care about their death benefit a little bit because they are a little older, they're afraid, they worry for their family, then we can do, I wouldn't do min-max, I would do based on target. It'll give you a little higher death benefit. So it'll hit both needs for death benefit and needs for cash accumulation. If you need the mobile app for Living Life, I would reach out to your upline. They might know a little bit more about the mobile app. Is income being deducted from accumulated value or cash surrender value? The accumulated value simply does not mean anything to your client. It's really just based off of what the money is growing that's in the index. So you see, we start pulling out income here, age 67. You see that your surrender value is slowly going down and your death benefit is slowly going down because when you're taking out a loan, it's coming off your death benefit and your cash surrender value. Your cash surrender value is what you have access to in cash. Your accumulated value, you see that will continuously go up. And that's because we're doing the participating variable loan right now. So the money is still being in the index, which will continuously grow. Okay, so the accumulated value means nothing to the client. They don't have any access to that accumulated value. They have access to the cash surrender value. Yes, the client can always call in to change from level to increase. Can the face amount be increased on a term policy that has been issued? You have to get with underwriting with that. You might have to just submit a whole new application for a term because term, you're in a contract, and if you continuously pay that premium, you'll get that insurance. But if you want more coverage, you're going to have to call into enforce and possibly have to reapply. How many times can critical ABR be triggered if you don't use all the funds? So let's say you accelerated 50% of your ABRs, and later, let's say it was only moderate, and then later on down the line you get another critical illness, and you have access. The next discounted rate will be off of the new death benefit that you have left. Term can convert to Living Life. As long as it's in those conversion periods, you can convert over. It's still one of our products, so we will allow it. Now, if you're doing a term conversion, the only thing you're really converting over is their health that they got credited. Cash surrender value is the amount the client would receive if they were to just walk away from their policy. Let's say at age 70, your client no longer wants to have the policy. They're done. They want to retire. They just want to live happily. They would get the total of $483,000 in coverage, or that's going to be their cash surrender value. They'll no longer have a death benefit. They'll no longer have a policy with us, but they will get that cash. And it's going to be tax-free if they did not MEC it as well. So there's not going to be a percentage that the client can take without the policy lapsing. As long as it's worth of three months of premiums in that policy, that's a good rule to live by. But even then, you want to continuously have 3 months of premiums in that policy. All right, guys, if there aren't any more questions, I'm going to be closing this webinar. Again, if you guys have any more questions later on that you guys can think of, always call back into our sales desk. We're always available at 1-800-906-3310, option 1. And thank you guys and have a good day, okay?